Hello, and my name's William Burrows. I'm founder of the Annuity project, and welcome to my latest newsletter, Annuity and Pensions Update for June 2025. Normally, I do these updates in written form, but I'm an experiment. I'm trying a video version, and if it's successful, I will do another one in a couple of weeks. So we're going to cover an update on annuity rates and trends at the same time, looking at the investments. We're in volatile times and the importance of de-risking. Quick look at IHT, unused pensions. We'll look at midlife MOT, an article in the FT, and how people underestimate their life expectancy. So if there's one chart I need to use to explain annuity trends, what's happening with pensions, what's happening with drawdown, it's this one. So let me explain what's happening. The blue line at the top, the solid blue line, is an annuity rate expressed as a percentage. So that's the annuity for a £10,000 for a single live person at age 65. The shaded area, the lines at the bottom, that is the FTSE, the stock market. Now we know the stock market's not the best proxy for a pension pot at retirement because people should have a mixed portfolio, but it does the job. So what's happening here? So let's start off at the credit crunch. This is 2008. Look at how the stock market fell and look at how annuity rates were falling. And this is the so-called double whammy: falling annuity rates, falling fund values. Then we had a period of quantitative easing, QE, and QE means that interest rates fell to very low levels. In fact, we can see here the base rate got to 0.1% back in sort of 2020. Now look at what's happened at the Brexit referendum. The bond yields and annuity rates fell very low, but it wasn't until 2020 did we see that annuity rates fell to their lowest levels ever. But look at what's happened since then, since the war started in Ukraine. Inflation spiked. I mean, bad news for those people on fixed incomes. But bond yields shot up, annuity rates shot up. And look at Liz Truss's fiscal event. And if you remember, crisis in the bond market, yields went to very high levels. I talk about bond yields, and I'm assuming that you all appreciate that annuity rates and bond yields move in the same direction. So bond yields are falling, so are annuity rates, and vice versa. And here we are. We arrive at today with Trump and his tariffs. It doesn't show on this graph because it's over a long period, but since January of this year, most people will have seen their funds, if they're in the stock market, probably sort of fall about 5-7% in the middle of April. Now in June, most people have seen their funds nearly back to the January levels. Most people probably are sort of down 1 or 2%, and annuity rates are still on the increase. So now is actually quite a good time to buy an annuity for two reasons. First of all, as you can see, annuity rates are quite high and they're back to where they were roughly pre credit crunch, and the stock market has recovered. Now, the $1 million question is, what's going to happen going forward? Well, I think annuity rates have peaked. Interest rates are earmarked to fall. Consequently, I think we'll see a slow, gradual decline in annuities. I don't think we're going to see any violent, any big downward swings, but I think it'll be a slow downward progression. But there's no rush. If you're thinking about buying an annuity, now's a good time. Let's dig a bit deeper into the stock market and annuities. My own view is that it's really important to de-risk as you get older or wanting to take income, and you shouldn't take undue risks. I make a very important point. The amount of annuity income you take, and to that extent, drawdown income, is a product both of the annuity or the drawdown rate plus the value of the pension pot. So you have to watch the relationship between rates and pension pots. In simple terms, if you've got your pension pot increasing, but annuity rates are falling, the two will balance themselves off. If the reverse, if you have falling fund values but increasing annuity rates, that's also a balancing act. One thing you have to watch if you're in drawdown is the sequence of return risks. Sequence of returns means that if you see a forecast or a projection, it's normally a linear percentage. So typically a quotation will say, if you have 5% return every year, this will be the outcome. But of course, in reality, the stock market doesn't go up uniform. Some years it might be up 10%, some years it might be down 5%, and so forth. And sequence of returns means that if you, let's say, start off with £100,000 taking, say, 4% income, but the value of your pension pot falls to 95,000, you're taking 4% from a smaller value, or you're having to sell units at a depressed price. There are various strategies for mitigating sequence of returns, and I'll try and do a blog on my website. And finally, I think it's really patronising to simply say, don't panic when market falls. I'm sure you've all received a letter from your advisor, and you might have even seen one from me, recently when the stock market fell, saying, don't panic. I think that's patronising, and I only say don't panic with one proviso, one caveat, and that's you haven't got to panic if you're invested correctly in the first place. And what does being invested correctly means? It means that you have well diversified portfolios in risk in line with your own personal risk profile. And finally, be careful about moving into cash. I'm actually moving some of my clients into cash slowly but surely. I'm selling some of the more high risk, more volatile funds and putting them into risk. But there are some people who do panic and look to move all of their funds into cash. And the next slide's a really interesting one. It's one that I saw at a presentation from Tatton. I don't promote individual investment funds or insurance companies, but Tatton have a range of managed portfolios, and they really are very good. I know the management team well, and the performance is very strong, and I use Tatton in a lot of my portfolios. But this is a slide, and what this slide does is it shows the returns after 1 and 3 years following a shock. So we start off with the Gulf War, whenever that was, a long time ago, and 1 year after the Gulf War, if you remember, that it was an oil crisis. Oil prices jumped up, so stock market fell, but a year later the market was up a little bit. 3 years later, up over 20%. Look at 9/11. After a year, the stock market was still down, probably down about 5%, but 3 years later, up just short of 10%. Look at the Brexit referendum. A year after, the markets have bounced back. 3 years later, the market back up. And even look at more recently, Russian invasion. A year after the invasion, markets are down 10%, but 3 years later, they're just coming back into positive territory. And the average, the bars to the right of the dotted line, show on average, after a shock to the system, 1 year later the markets tend to rebound nearly 10%. After 3 years, over 20%. Now, of course, the investment pundits and investment managers, would say that, wouldn't they? Personally, I'm a little bit more cautious, and I'm a great believer in making sure that you don't take undue risk in retirement. Let's have a quick look at IHT on unused pension pots. As we know, from April 2027, pensions will no longer be exempt from inheritance tax. So that means that IHT may be paid on unused pension pots when you die. I think in most cases, or in many cases, this will not be an issue until second death. Take a scenario of man and wife, man dies, pension pot can transfer to the wife with no IHT consequences. It'll be on second death when the money passes to the family. There is a consensus amongst pension specialists and the newspapers, and you've only got to read the Daily Mail or the Telegraph to say that they're all saying consider taking income, paying the tax, and spend your money. And a good way of spending is considering gifting to the family. Inheritance tax can get quite complicated, but there's a very simple rule that says if you can give money away out of normal expenditure, so you can show that it's regular and it doesn't affect your standard of living and it's surplus money, you can give it away free of IHT. And a good way of doing that is by arranging an annuity, because it can be clearly documented. We're still waiting for confirmation of exact rules, and sort of one of the reasons why I've not been sort of pushing solutions on my clients is we're still waiting for the exact rules. There's some pretty sort of nerdy and technical stuff about taxation or potential taxation of annuity guarantees and things, and until I know the rules on that, I'm holding back from giving detailed advice. There's a brilliant article in the FT in May by Maura O'Neill about the importance of reviewing finances in mid-retirement. I'm a great believer in saying that there's 3 or 4 steps through retirement. You've got the pre-retirement, at retirement, during retirement, and later life. But the article is based on a report that says if you set off on the wrong foot, don't forget we're 10 years down the road now from pension freedoms, and if people set off on the wrong foot, it's crucial to review their plans. There's an interesting point that 75 may be the middle point of retirement, but not necessarily the midpoint of spending. I like the explanation. 75 is after the go-go years of heavy spending on recreation, going out and travelling, but the prospects of sizable end-of-life care costs is looming. So just because you get to 75, you might have a dip in income, the so-called U-shaped income curve, but later life there could be lots of expenditure on the horizon. And I'm quoted in dispatches by saying, it's essential for retirees to consider their investment risk. When people first retire, they underestimate their life expectancy, but later there's a realization that the life expectancy may exceed 90, for example, and there is a need to de-risk. And this takes us nicely into a more recent article last weekend, June the 7th, again by Maura, looking at living longer. And basically it's a wake-up call from a survey showing how people underestimate their life expectancy. A bit of research by one of the pension consultancies says women at age 65 underestimate their life expectancy by 7 years. Apparently the average expectancy is 89, so women will be sort of guessing that they live to 82, say. Men, they underestimate by 4 years. And the next slide, I'm going to give some examples of life expectancy. These are taken from the Office of National Statistics. This is a man age 65 can expect to live for 85 years. But if you're an actuary, and I'm not an actuary, but pricing annuities, you'll give someone at 65 20, 25 years to live, and you can see that sort of fits between a 1 in 4 and 1 in 10 chance. And look at that, nearly 3% chance of living to 100. For ladies, lady at 65, they can expect to live 80 years. But again, an actuary will give them 25 years, anything between sort of 94 and 98. I mean, this reminds me of the famous quote from Voltaire: "I urge you to carry on living solely to spite those people buying an annuity." One way of describing an annuity is a bet, with an actuary. And if an actuary is going to, give you to, sort of age 90, what are the chances of you living past 90 and winning the bet? So why is it important not to underestimate life expectancy? First of all, it helps explain the annuity puzzle. Why if annuities are so good, why don't more people buy them? The simple answer is people want to leave an inheritance and they're frightened of giving their money away. But it's really important to be realistic about life expectancy when planning pension drawdown annuities. First of all, you need a cash flow to show how much income you need, and rising income. Think about having guaranteed income for essential spending, the so-called income pyramid. Don't put your income at unnecessary risk. It is easy to underestimate the risks of pension drawdown. Don't forget about inflation. Inflation's like sin. Every government denounces it, but they all practice it. And most importantly, don't run out of money. So that's it. Thank you for listening to this, and I hope this has worked. Be sure to watch my other videos, and if I have good feedback, I'll do another update in a couple of weeks' time. So thank you very much, and bye.